Hi, Scott Nelson, Senior Wealth Manager with Boulay Financial Advisors with your second quarter market review. The Federal Reserve's aggressive raising of interest rates continued to pull bonds down in the second quarter. Overall, the U.S. bond market was down over 4.6 for the quarter and is now down over 10% for the year per the U.S. Aggregate Bond Index. Government bonds did a bit better than the overall index, down a bit over 3% for the quarter, while concerns about the impact of inflation on corporate earnings pulled investment-grade bonds down just over 7% and high-yield corporate bonds down over 9%. This year has been a painful reminder that when interest rates go up, the value of many bonds go down. And you will not find a more extreme example of that than what has happened in the 2-year Treasury bond market. As you can see, a 2-year Treasury bond issued today is yielding over 10 times more than one issued a year ago that yielded 0.25%. While last year's bonds are worth less today, higher rates mean that your bond fund will be yielding a lot more in the future as those older bonds get replaced. Just like the bond market, the stock market pullback deepened in the second quarter. The overall U.S. stock market fell nearly 18% and is now down approximately 21% for the year, according to the broad Russell 3000 index. International stocks also fell approximately 14.5% for the quarter per the MSCI All-Country Index. Emerging market stocks did slightly better, but were still down over 12%. Obviously, it has not been a great year for stocks, but one has to appreciate that despite being down 30% this year, the 3-year return of growth stocks is still nearly 11.7%. And that's due to their incredible outperformance over the past several years. That 3-year return remains 3 percentage points higher than the 3-year return of value stocks, which are down less than 10% this year. With stock market now down over 20%, you may have heard that we are officially in a bear market. Is there some significance to this? Well, not really. Over the past 40 years, the stock market has experienced 10 bear markets. And as you can see, many of these were just short setbacks due to typically market overreaction to some event. The longer bear markets, though, coincide with economic slowdowns in 1980, 2000, and 2007. So bear markets come in all shapes and sizes, but if we look at the 17 bear markets since 1946, we see that the average bear market lasts around 11 months and experiences an average market loss of 29.6% before things turn around. What happens once things turn around? The average return the year after a bear market has been a strong 23.9%, which is a good reason for writing things out to get to the reward on the other side. We appreciate that writing out the market's ups and downs can be nerve-wracking, but as I pointed out with Treasury bonds and growth stocks, values of many investments got pushed to unreasonable prices that they needed correcting to bring their values back in line with economic realities. So as the summer begins to wind down, the best advice we can offer is to find a nice shady hammock, let the markets work themselves out, and know that we at Boulay Financial Advisors are monitoring the situation as part of our continued effort to help you get where you want to go. So that is the market situation at the midpoint of 2022. Always remember that if you have any questions about your portfolio, don't hesitate to reach out to your Boulay Financial Advisor. Thank you and have a happy, safe summer.